You pulled up the charts on Friday evening. Silver settled just above $80 an ounce. You closed the tab. And then something strange happened. You went looking for answers, and instead, you found three completely separate realities. In one corner, the optimists, the weekly close was clean, they said. Momentum is building. The Sunday evening open is going to confirm everything. In another corner, the skeptics. The positioning data is screaming caution. The rally is borrowed time, and Monday opens with a reversal that punishes everyone who chased the Friday candle. And then there is a third group, the quiet ones, who believe nothing dramatic happens at all, that the market simply churns sideways, waiting for something bigger to break the tension. Here is the uncomfortable truth about all three groups. Statistically, most of them are going to be wrong. Not because they lack intelligence, not because their analysis is sloppy, but because they are all making the same foundational error. They are treating Monday morning's opening price as a verdict on what happened Friday afternoon in New York. It is not. Not even close. This is where it gets interesting. The price that prints when the COMEX electronics session comes online at 6 p.m. on Sunday isn't a reaction to the Friday close. It is a reckoning with 48 hours of continuous price discovery that took place while North American retail traders were completely offline. In Sydney, in Shanghai, in London, in markets where individual investors on this side of the world have essentially no real-time visibility. The gap, if there is one, is not a signal. It is a summary of conversations you were not part of. And right now, silver is not just any commodity sitting at any random price. Silver at $80 in May of 2026 carries enormous context. This metal touched nearly $122 per ounce in late January, a level that genuinely shocked veteran analysts who had been anticipating a structural repricing for years. Then the Strait of Hormuz crisis reignited energy inflation, complicated the Federal Reserve's calculus, and silver shed more than $40 from that peak in the weeks that followed. It is still roughly 50% above where it traded 12 months ago. However, the decline from the top has left a very specific market structure in its wake, one that is setting up three distinct mechanical scenarios for this particular Monday open. Each scenario is internally coherent. Each one will look, on the surface, like confirmation of whatever you already believed heading into the weekend. That is the trap. Understanding why requires a clear look at what is actually happening beneath the price. Let's start with the structural foundation, because it is more unusual than most commentary is acknowledging. Open interest in COMEX silver futures remains elevated. Paper claims against the registered physical inventory represent a coverage ratio somewhere in the 12 to 15% range, meaning the futures market is leveraged against a relatively thin physical base. Shanghai silver premiums over London spot have been fluctuating persistently in the 3 to 8% range for several weeks, signaling consistent Eastern demand that is quietly absorbing every price dip without announcing itself through the kind of dramatic premium spikes that would attract algorithmic attention. Wholesale delivery delays on larger orders are running 4 to 6 weeks, elevated but not yet at crisis levels. The gold-to-silver ratio has stabilized in the low to mid-60s, a zone that historically precedes silver's most aggressive relative outperformance. And the commitment of traders data tells a layered story. Commercial short interest near the 70th percentile of its 5-year range, large professional speculators positioned cautiously bullish at roughly the 55th percentile, and retail, the small speculator category, sitting near the 80th percentile long. Dealers leaning short, professionals cautious, retail heavily committed to the upside. That combination is structurally constructive over any meaningful time frame and tactically fragile in the short run, because it creates precisely the conditions under which a Monday gap becomes a shakeout mechanism rather than a directional signal. Now, here is what almost no one explains properly: how Monday gaps actually form. The first driver is institutional rehedging. The major bullion banks running matched book operations, simultaneously long physical and short paper, or the reverse, must rebalance when the COMEX reopens after weekend physical market activity. If sovereign wealth funds absorbed metal in London over the weekend, or a Shanghai exchange member pulled inventory, the dealers come into Sunday evening effectively short physical and need to buy futures. That buying creates the upward gap. The opposite creates a downward one. This is institutional rebalancing, not retail sentiment. The direction of the gap tells you something meaningful about what happened in physical markets while you were not watching. The second driver is margin and expiry mechanics. A speculative fund that received a margin call Friday afternoon has until early in the next session to post collateral or liquidate. If they post, the selling pressure that bears are counting on simply does not arrive. If they liquidate, the selling hits in the first minutes, creating a gap down that looks bearish but may actually represent the final clearing of weak-handed positioning before the real directional move begins. This is, without exaggeration, the single most misread dynamic in precious metals trading. The third driver is narrative lag. By the time financial media in North America reports the development that moved Asian markets Sunday night, the professionals in those time zones already acted on it. The gap is the arbitrage. Retail trades it as though it is news. It is not news. It is already history. 3 mechanical setups are now structurally possible for this Monday open, and each one has a specific signature readable in the first 90 minutes of trade. Scenario 1. The gap up trap. Silver opens Sunday evening 2 to 4% above Friday's close. A supporting headline emerges: progress on geopolitical negotiations, a softer dollar reading, encouraging industrial demand data. Retail sees the gap, interprets it as confirmation, and buys into the momentum. The opening 30 minutes looks strong. However, somewhere between 45 minutes and an hour into the session, volume spikes and then collapses. The high of the day is printed. By the time New York equity markets open Monday morning, silver is fading. By late morning, most of the gap has been retraced. End of day, it closes below Friday's settlement. The tell is the Shanghai premium data. If premiums contracted over the weekend and the London morning fix prints flat relative to the Asian session close, the gap up was almost certainly a dealer-driven operation designed to attract retail buying at elevated levels before institutional participants reduce exposure. Volume evaporation after the initial spike is the confirmation. If you are long into that structure, the market is telling you something. Scenario 2. The gap down squeeze. Silver opens 2 to 4% below Friday's close. The narrative is bearish: a hotter inflation print, hawkish Fed commentary, renewed safe haven flows into the dollar. Long-positioned retail traders feel immediate pressure. Some sell in the first 30 minutes. Volume spikes. The bid temporarily disappears. But here is what is actually happening underneath. If Shanghai premiums expanded during the weekend session, if Eastern buyers used the temporary weakness to absorb physical metal at discounted prices, then the New York selling is not a fundamental repricing. It is finite margin liquidation. When that forced selling exhausts itself, typically within 60 to 90 minutes of the COMEX open, the physical bid that was present before the gap is still present. The reversal that follows is not a bounce. It is a resumption. The volume spike marking the exhaustion of selling pressure, with the bid visibly returning in the order book before retail has finished reading the bearish headline, is arguably the highest probability entry point in the entire weekly trading structure of this market. Scenario 3. The silent melt-up. Silver opens within 0.5% of Friday's close. No gap. No headline. No drama. Retail checks the price and moves on. The first hour is quiet and narrow. However, dealer inventory remains depleted. Shanghai premiums remain elevated, and the next wave of industrial or sovereign buying has not yet reached the open market, but it is approaching. What follows unfolds not in a single explosive session, but across the full week. Volume builds through Monday morning without a single obvious trigger. Price grinds higher in a low-drama, relentless advance. By Friday, silver has posted an 8 to 10% gain from Monday's open without ever offering the clean pullback entry that most traders are waiting for. The move happens to the people who are already positioned, not to the people still looking for their entry. 3 falsifiable predictions follow from this framework, and they will either hold or they will not by Tuesday morning. If silver gaps more than 2% in either direction Sunday evening, that gap will be at least 60% retraced within the first 4 hours of COMEX floor trading. A Sunday open at $83 should see $81 or lower by late morning Eastern. A Sunday open at $77 should see $79 or higher by the same window. If Monday's front-month futures volume exceeds its 20-day average by more than 30%, while price closes within 1% of Friday's settlement, the silent melt-up scenario is active, and silver will print a new multi-week high by the following Friday. And if Shanghai premiums on Monday morning are above 6%, any gap down at the New York Open reverses within 2 hours and closes green. If premiums are below 3%, any gap up fades and closes red. These are not opinions. They are mechanically grounded benchmarks tied to publicly available data, and they will be verified or falsified in real time. Now, in the comments below, tell us where you are watching from, which of the 3 scenarios you believe is most likely, and 1 sentence of reasoning. Drop your city, your current positioning, and your specific reasoning. The most precise call with the sharpest logic gets pinned and highlighted in the next Silver Dispatch breakdown. Because scenario planning is not about predicting the future. It is about being prepared for multiple futures before any one of them arrives. Most traders lose money on Monday gaps, not because their long-term read on silver is wrong, but because they are right at the wrong time, buying the trap, selling the squeeze, or reacting with emotion to a structure they have never been shown how to read. When you have thought through all 3 scenarios before Sunday evening, you stop reacting to price and start reading structure. You stop asking whether silver is going up or down and start asking which of the three mechanical patterns is currently unfolding and what the first 90 minutes are confirming or denying. Silver at $80 in May of 2026, 50% above where it traded a year ago, down nearly $40 from its January peak, sitting in a decision zone with depleted dealer inventory and persistent Eastern demand. Against a geopolitical backdrop that markets historically resolve with violent, decisive moves, this is not a moment for comfortable consensus. This is a moment for frameworks. As always, everything discussed here is strictly for educational and analytical purposes, not personal financial advice. Nothing in this breakdown constitutes a recommendation to buy or sell any instrument. OG Peter for Silver Dispatch. Do your own research, manage your own risk, and see you at the next open.